Hi there, Paul Ferrarisi with Founders Group. Thanks for stopping by. We've got some educational information we want to share with you. At the end of the program, if you want more information on it, we'll explain how to get it. Thanks again for stopping by.
Hi everyone, Paul Ferrarisi at Founders Group. I've got some information I want to share with you that I think is important and can be helpful to you. One of the things we have to do here at Founders Group is to manage investor behavior. Isn't it funny? When markets are going up, people are pouring money into the stock market. When the stock market hits bottom, they're pulling out every penny that they have, which is the opposite of the old adage, buy low, sell high. What I want to cover is the normal wave and movement of the stock market. And the chart you see is a summary of the stock market, that is the S&P 500, back to 1870. So let's take a look at our chart here. If you follow along this red line that moves up to the top right, that's what we call the trend line. That's over periods of time. This chart goes back to 1870 up to present. And you'll see a nice upward sloping movement of the stock market. The jagged blue line represents the actual movement of the S&P 500 with various dates. You'll notice there are periods of time we're above the trend line, periods of time below the trend line. And in many cases, if you look, we can go for decades above the trend line, but it balances out with decades below the trend line there. It's just like all of nature. We get cold winters followed by very hot, dry summers, and it just balances over time periods. You will see kind of shock periods like I'm examining here in 1929, when it got a little out of whack and then really dropped precipitously. In fact, if we look at segments that are on here, right around 1920 it had kind of hit a low. The roaring 20s led it up to 1929. Then the drop came in the Great Depression. And notice it took until around 1954, 1955 before they pierced the trend line and started in a positive track. We'll look over to the far right here, and you'll see just before the tech wreck around 2000, Alan Greenspan, the former head of the Federal Reserve, was screaming all the time irrational exuberance, and people laughed at him. It was followed by a pretty hefty drop of almost 50%. You'll notice something here. It never corrected below the trend line because the then present Federal Reserve and the U.S. government didn't want any bad things happening. So they lowered interest rate, started plowing money back in. We moved higher again until 2007, 2008 to be followed by that terrible drop of 50% in 2008, 2009. Now notice it breached the trend line just momentarily because again the Fed came in, lowered interest rate to almost zero here in this country, and at the same time started the quantitative easing. They put in over $4 trillion of money trying to shore up the system, getting people to put money back into the stock market. And so now we move along to where we sit today. As of this recording, it's about the middle of August 2018. What I want you to see is, remember our red trend line going up nicely to the right. We've converted that to a black horizontal line. All right, so all we did was straighten out that line. These various little mountains above and below the trend line are a representation of the S&P 500 blue line just right above it. And again, we've got periods of time above it, periods of time below it. Not getting too technical on you, but for the engineers and mathematicians out there, you'll notice something here, and that is when we approach about 1 standard deviation above the trend line, it always corrects about 1 standard deviation below the trend line, approximately. So what I want you to look at here is we went above the trend line about 88%. You'll see it here in 1929, about 80%. On average, so you have an understanding of this, when we go above the trend line roughly 50%, it will always correct about 50% below the trend line. When we get more up near 2 standard deviations and we get into the 80s or so, you'll see corrections of 60 to 70%. Very average, it moves like waves, it's pretty standard. What I want you to really note here is in 2000, the irrational exuberance, we got 134% above the trend line. Now, you would expect it to correct somewhere around probably 80 or 90%, never did. Again, right after the tech wreck, the Fed, and backed up by the U.S. government, started pumping money and lowering interest rate. We got up to the level of about 76%, similar to 1929, similar in shape there, and we dropped 16, 17, 18% below the trend line momentarily. That's when they started the quantitative easing and started pouring tons of money into the economy. You'll see as we sit end of July, 1st of August 2018, we're sitting at 116%. When we ask clients one-on-one or in a class, we ask them, hey, do you think the stock market's going to continue to go up and up and up and never ever drop? And they all giggle and say, no, no, no. And I ask for a show of hands. How many think the stock market's going to drop? Hands go up. How many think that it's going to be a pretty heavy correction? Markets go up again. I am not advocating that the market is going to drop from here. Folks, we've gone about 2 decades here. As you're looking back to the left, we can go many, many decades before the correction takes place. But like Humpty Dumpty, the higher and higher on the wall I go, the greater the fall is going to be. It's just normalcy that takes place. So here we're sitting at about 116% above the trend line. If you look to the top of the page, the paragraph we've got written about the only certainty in the stock market is that over the long haul, overperformance turns into underperformance and vice versa. I can relate that to sports. A baseball player may hit way above their average and then they go into a slump and it just averages over time. Here's the mathematics that I want to share with you here. And if you read the second paragraph, the peak in 2000 marked an unprecedented 137% overshoot of the trend line, substantially above the overshoot that took place in 1929. The index has been above the trend for 2 decades, with one exception. It dipped about 15% below the trend line briefly in March of 2009. So at the beginning of August 2018, where we are right now, it is 116% above the trend, exceeding the 68% to 90% range it hovered into for about 37 months. It's about 1 standard deviation up to about 2 standard deviations. In sharp contrast, the major troughs of the past saw declines in excess of 50% below the trend. If the current S&P were sitting squarely on the regression line, it would be at 1294. Folks, let's round that off to 1300. What are we trying to say in English here? If we had a correction from the 116 and just went down to the trend line, whether it's the horizontal black line or the red ascending line here, that means the S&P would be at 1300. As I make this recording, the S&P 500 is sitting around 2700, 2800. So that would be a 50% drop in value, to drop from 2800 down to 1300. Now, normalcy dictates that a normal correction will drop it down to about 50% below the trend line. Folks, if you take 50% drop from around 1300, that would drop the S&P value down to around 650. So that means a normal correction would be 2800 down to about 650. That's a loss of 75%. Am I advocating that it's going to take place tomorrow? No. Am I telling you to sell all your stocks and put the money under a mattress? My goodness, no. But the question that you should be asking yourself is, can you handle that loss that's on there? And so if you can't financially, that is, well, I don't have another 30, 40 years to make it up and hope that things come back over time, you need to have an exit strategy. You need to have a defensive strategy. One way that we help our clients protect money that they have in the market is by using tactical money management. 95% of Americans use what's called the buy and hold strategy. The buy and hold strategy is you've got your money in the market at the top, at the bottom, in between, all along. That's not too bad during an accumulation phase, but if you're 10, 12, 15 years from retirement, you can't afford that. Plus, even if you're not 10, 15 years before retirement, why would you want to give up losses? At another time, I'll present to you how tactical money management works, but basically, it's using professional money managers that will allow you to get 80% of any rise that is on the upside, but at the same token, they avoid 80% of the downside. And research study after research study shows that you will come out double or triple ahead over the long term of the traditional buy and hold.
Well, I hope you found that information helpful. If you feel your family, friends, or coworkers might also benefit from it, please share this link with them. Now, if you want more details on this, at the end of the video, we'll share that information with you. Thanks again for stopping by. Bye for now.